This is Vishal Seth, and I'm extremely glad to host the session today on the changing landscape of due diligence and potential impact on deal structures. I have with me an esteemed panel of senior leaders from leading private equity and venture capital firms across the country. I would like to welcome all the panelists and thank them for taking out time to share their valuable insights on the subject. Our session today is scheduled for 90 minutes, which includes 20 minutes that we will spend towards the end of the discussion to take any questions from the panelists. All panelists will be on mute, so would request you to register your questions on the Q&A panel on your screens, and we'll take the questions towards the end of the discussion. I'll now briefly introduce our panelists. We have with us 6 panelists today for the session. Our first panelist is Mr. Ramakrishna KV, or Ramki as a lot of people call him. Ramki is a Chief Executive Officer at Kotak Private Equity Group and has been with the group since 2004, with over 25 years of experience in the private equity and venture capital industry. He is instrumental in building Kotak Private Equity investment focus with a value-based long-term investment strategy. Prior to Kotak, Ramki has been associated with Carlyle Group and ICICI Ventures. Welcome, Ramki, and we're glad to have you on the panel.
Thank you, Vishal.
Our next panelist is Neha Grover. Neha is currently the South Asia Regional Lead for IFC's Private Equity Fund, a World Bank Group company. In her current role, Neha is responsible for identifying and investing into private equity funds, managing the current PE portfolio, and focusing on the co-investments. She also serves on the advisory boards of 6 private equity funds. Prior to IFC, Neha was working for 12 years with Baring Private Equity India and has been part of 2 complete fund cycles with Baring India. At Baring, Neha was a principal and the CFO. Neha also features as one of the top 100 women in finance in India, as per the Association of International Wealth Management of India 2019 list. Congratulations, Neha, and welcome on board.
So much. Happy to be here. Thank you.
Our next panelist is Prakash Bagla. Prakash is principal at Motilal Oswal Private Equity and has been with Motilal Oswal Private Equity since 2007. At MOP, Prakash is responsible for deal sourcing, investing, monitoring, and managing the exit of portfolio companies. Prakash primarily focuses on companies in the industrials and manufacturing businesses, and he has more than 15 years of diverse experience in consumer-facing businesses, including Imami and mining and oil business at Aditya Birla Group. Prakash represents the existing funds on the boards of Electromech, Magic Crate, IMP Powers, and Glasswall. Welcome, Prakash, and thank you for joining us today. I think Prakash is facing, I don't know if Prakash has managed to join us. He had some technical issue. Hopefully he should join us very soon. Our next panelist is Sandeep Kher, who is the Director and Head of Portfolio Finance for Sequoia Capital India. Sandeep is passionate about growing businesses and exploring new ideas and finds the high-octane environment of the entrepreneurial world stimulating. He likes to be a business partner to founders, helping them integrate the world of business and finance for sustainable value creation. Sandeep helps manage data and analyze financial information, strategize on aspects of operational finance, implement best practice and processes as businesses scale, set up business plans, help raise alternate capital, and enhance compliance, including governance standards. Welcome, Sandeep. It's great to have you here with us.
Thanks.
We also have Rahul Kapani from True North. Rahul is a director at True North Private Equity, and he's been there with True North since 2012. Rahul is responsible for assisting the fund managers with the tax, legal, finance end of the deal process during both entry and exit stage, and helps building leading finance and treasury functions at the investee companies. Rahul has over 19 years of prior experience, having been part of building a global risk consulting practice, which was subsequently integrated with a New York Stock Exchange listed company. Rahul also headed the M&A and legal team in another New York Stock Exchange listed company and was part of Anderson's financial services practice. Welcome, Rahul, and thanks for joining us. And our final panelist is Nimisha Nagar-Sekhar. Nimisha is a partner and CFO at Sixth Sense Ventures. She's a finance professional with 18 years of consumer experience with expertise and strategic acumen in the areas of brand management, supply chain, treasury, designing, planning models, and financial accounting. Prior to joining Sixth Sense around 3 years back, Nimisha was heading FP&A and investor relations for Colgate-Palmolive India. Leading investor relations for Colgate, Nimisha was instrumental in elucidating the company's growth strategy and story behind the numbers to analysts and investors. Nimisha has also won the Chairman's You Can Make a Difference Award at Colgate for her contribution to the regional supply chain projects. Welcome, Nimisha, and we look forward to hear from you as well.
Thanks, Vishal. Glad to be here.
Right. So with this, I would like to kick off the discussion today. Bearing some high-value transactions that have been executed in the pharma and healthcare space, and the phenomenal and extraordinary $20 billion fundraise by Reliance Jio, the overall slowdown in the businesses has led to a pause in the investment and M&A activity over the last 3 months. The investment and M&A activity is expected to recover slowly in the coming quarters, though investment activity may take a bit longer than the M&As. Just as businesses are relooking at the future outlook and preparing themselves to a new normal, even the financial and strategic investors are reviewing their investment and growth strategies. Our webinar today is going to focus on the following 6 themes. Number 1, change in the approach of due diligence exercise and some practical challenges. Number 2, the emerging due diligence areas such as ESG and technology DD. Number 3, we will discuss how some of the existing private equity and VC-backed companies are adjusting to the unprecedented event and measures that are being taken to ensure their businesses continue to sustain and grow. Number 4, some key areas to keep in mind when investors look at the balance sheet of the target company before making an investment. Number 5, potential impact on deal structures and conditions precedent to ensure successful closure of a deal. And finally, some thoughts on the valuation considerations. We've got a full-on session today. With that, I would invite our panelists and request each of them to spend a couple of minutes and share their perspective and personal views on the investment and M&A outlook. What are 2 or 3 things or areas they would look at differently before investment decision? And do they think that a robust due diligence is going to be of great significance? So maybe we'll start with Ramki first and then get the opportunity to hear from the other panelists for a couple of minutes. Ramki, over to you, please. Ramki, you're on mute.
Yeah. Thanks, Vishal. Thanks. And good evening, everybody. Vishal, I think you have actually given a very good summary of the current situation. As all of us would agree, the fundraising market, including M&A, is going to be cautious in the whole of current year. I believe at least till the first quarter of next year, when hopefully we see better visibility on the vaccine. So the healthcare crisis probably should end, and hence the recovery in the economic cycle and the investment cycle. Having said that, Vishal, in my own opinion, strong companies will continue to see investor interest. On the contrary, I think they will see a lot more investor interest because of the paucity of, I would say, quote unquote, good companies. But the challenge I have seen in such times is sometimes given the current valuation, such companies may not actually want to do deals now, and they tend to postpone this. That's been a classical cycle I've seen. But strictly from a business perspective, my advice always is if there's a need for capital, they should not just hesitate. They should not be first about valuation, but just focus on the larger opportunity and the growth. Mm-hmm. Coming back to what you had asked from an investor perspective, there is going to be a lot of caution because, again, coming from LP standpoint, as well as the uncertainty in the market. I think the business impact in the current year is given. There is no uncertainty about that. All of us know that there's an impact. I think the capital markets have already started discounting FY22 numbers. Having said that, from our investor perspective, the test in evaluating new deals, Vishal, is to see if the impact is going to be temporary or permanent. As long as the impact is temporary, we can always structure the deals and move on. So that's the way I'm looking at the current investment market, Vishal.
Excellent. And how do you think, Ramki, do you think the significance of due diligence is going to be bigger than before, or is it going to be similar to what you've been seeing in the past?
So I think, on a lighter note, Vishal, everybody has time on the side. So you do more diligence when you have time on your side. So, yeah. I'm sure, people will be actually looking at numbers a lot more closely, and hence the importance for diligence would be a lot more in the current environment.
Yeah, and I think we will briefly touch upon subsequently on how do investors maintain a balance on the DD side. So thanks a lot, Ramki. Neha, if you could share your perspective again from an IFC, being an LP, investing in private equity funds or also co-investing, how do you think the landscape is changing? And how do you think, what are the 2 or 3 important things that you are looking at when you're looking at target companies?
See, from an LP perspective, one thing which is very different when any of you all are looking at direct companies, we are we're looking at, or we're doing diligence, we're conducting diligence, but we are not doing a primary diligence, so to say, right? The GP or the manager that we're working with, we're relying on their expertise and their knowledge to sort of conduct the diligence and take it to the next level. So to that extent, we are for us as an LP, it becomes important to make sure that our GP is doing a good job and to ensure that we are comfortable with what they are doing and we feel that they're doing a good job. That's one. Of course, for a lot of companies where we're already familiar with the companies, or if the GP is already familiar with companies, relationships that they've had in the market, diligence can actually take a little bit of I wouldn't say a back seat, but a lesser or a smaller role, because you're already very sort of familiar with the company, you're familiar with the promoters, with the sort of entire market as well, and therefore you may actually choose to do a limited diligence on these kind of companies. Of course, what needs to be seen, as Ramki mentioned, it's critical to see whether the impact of COVID on such companies, whether you have a relationship with them or not, is it permanent? What is the impact on their business? How long term is it? And therefore, whether you can rely on the diligence you had done earlier, or do you need to do a fresh set of diligence? So I think the diligence is more in such companies around what is the impact of COVID and how is the business model changing, or how are the demand or the supply parameters changing. For completely new sort of relationships, I think diligence is becoming more critical. Diligence will also be more difficult because you can't travel. Even if you travel, you can't now use numbers for the last 3 years as a proxy for the next 3 years, because the next 2 years may be completely different from the last 2 years, or the trajectory that the company was facing or seeing could have changed dramatically. So therefore, diligence actually becomes more critical. As an LP, I think even when we're looking at funds, I think when we're looking at companies, we see it at the way any other investor sees. When we're looking at funds, I think it is slightly easier because we don't have to go to the GP's office to understand everything. A lot of it can be done virtually, especially if we've known the GP, if the GP has been around, if there is a track record to sort of base our diligence on. It is definitely sort of easier.
Yeah. Okay. Thanks, Neha. We'd love to hear a bit more about some of the new DDs that will happen. But I think there are a couple of things that will be interesting to hear from you in some time. Nimisha, from a VC perspective, how do you think the landscape will change? And again, from a slightly more from a strategy side, would there be any specific focus sectors, or it's only a matter of, say, getting a bit more careful of doing a diligence? But I think, is there a complete change in the shift in the way you look at a company or an investee company, or you would look at post-COVID?
So Vishal, any situation like this, whether it's a pandemic or an economic downturn, will necessarily lead into capital restrictions and cautiousness in mindsets in investing. Whether it's the LP investing in VCs or Ps, or it's funds investing in companies, right? And every aspect of investing and diligence will only get accentuated across promoters, scalability of the business, how sustainable do we think the business is. So it'll be interesting to see how the current portfolio companies also shape up. And it just, this kind of a situation just tests the character and resiliences of business and founders in this situation. So for us, I would think the investment theses and what we look at the companies will remain the way it is. But one would definitely want to be cognizant of whether the business that we are putting our hands into is has kind of got a temporary impact to it, or it's kind of permanent. Largely, I would think once things settle down, everything is going to be more or so temporary. Multiples and valuations will change depending upon which sector one is looking at. If one looks at EdTech today, just in the first 6 months, EdTech has done almost $80 million worth deals, which is as compared to last year was just $60 million. So it's like a huge, super hot sector that everyone is wanting to get into. Or something like e-commerce, right? E-commerce in the first 6 months has done just 25% of its usual business. So any business which is internet friendly, is more online based, will definitely see a much high scale up as we move along in the next 12 months. So it depends on which business and which sector one is looking at. Also to add something like drivable distance vacations. Today, everybody is so holed up in the house for months that when things open up, there'll be a huge pent up demand that will drive the growth in these kind of offerings. So it's going to be really interesting.
Yeah, so it's going to be more of a wait and watch situation. So what I'm hearing is there is nothing like a sector, no sector that will be there in a no list, right? As compared to the pre-COVID situation, it's just a matter of businesses coming back to normal and getting used to a new normal.
Sure.
Thanks, Nimisha. Sandeep, any thoughts from your perspective, from where you are sitting at, and obviously you are also helping some of the investee companies in their financial improvement and building in some good processes, best practices in those businesses as well. What is your view on the outlook of investment activity, and if there is going to be a significant increase in the relevance of due diligence, Sandeep?
First of all, Vishal, thank you so much for organizing this. Glad to be here, and thank you for all the attendees who are taking our time to hear all of us. In my current role at Sequoia, I do supervise all diligences that get commissioned. I've also had the good fortune of being on the other side a few times earlier in my career. So from that standpoint, I think, and maybe I'll answer the second question first. I think diligence importance will not be lost. I think what will happen is the diligence process would remain the same. The methodology may change a little. You may want to focus on a few areas which you probably were not, as deeply spending time on. So I think that's probably the shift that I see happening, and we have started seeing a little bit of that come alive. But per se diligence, will happen the way it was happening, and especially in our context. And I'm responding to this more from our concept, our standpoint, because we are early stage investors, and essentially at early stage, what you have is you start with an idea, then you go to testing the product, market fitment, and then you decide the GTM, and then you scale up, right? So it's a little bit of a time and a journey that you have to cover through. And typically, as investors, at Sequoia, we like to come in early. So at that stage, really, there is not much really of business, right, to that you see. But having said that, given the fact that we straddle across the spectrum, I think a few things that will emerge, and this could be temporary. I think there will probably be going forward a greater focus on unit economics. I think in some ways, I should say unit economics is going to be back in vogue. The earlier era, and I know this earlier era is about 3-4 months back, right, which was more focused on acquiring customers, driving growth at any cost. I think, and I don't want to say that this was irrational behavior. This was very rational, because at that point in time, money was available. I think going forward, money is going to be at a little bit of premium, and therefore the proxies for profitability will get sharpened, right? Earlier we had, even now we have concepts like GM, CM1, CM2, and people would think about one over the other and, find a proxy and then run with it. I think now you would want to stay more closer to a CM1, CM2, depending upon, again, how your customers acquisition cost is, how your retention ratio, cohorts behave, and so on and so forth. So that's one. I think the second, area that I at least would definitely want to focus as I, do diligences would be on the quality of revenue. I think that'll become increasingly more relevant. It's not that it was not relevant earlier, but I think at this point in time, you'll probably discern a little bit more. And you would want to understand how your, not just acquisition of new customers is behaving, but how your customers that you've acquired are staying with you. How are they behaving? How are they growing with you? And so on and so forth. If you're a B2B business, you would want to see, are you on the long tail or are you towards the enterprise segment? Because, long tail today would be more susceptible. Enterprise customers would have more solidity. So therefore, you would want to kind of, use that lens a little bit more astute. And I think, I probably say this, the old adage will probably come back today, which is revenue is vanity, profit is sanity, and cash is reality. I think that'll probably play out a little bit more as we see this. But mind you, this is going to be temporary. Things will come back to normal. The world will go back to its old ways, and we'll all could probably be doing the same of what we were doing. But I think this will set the current businesses that all of us are part of, would set them up more nice and more adapt to dealing with or coming alive with profitability is what I would say.
Yeah, I think I really like your point of saying the unit economics is going to start becoming, it's more like logical, right? That is something that has been sort of ignored for some time, where scalability has been the top priority of many, at least the new businesses, the new age businesses, without extensive focus on whether it is making sense at a unit level. So we'll come back to that, Sandeep. I think that's a very valid point, whether there's going to be sustainability versus scalability, right? That's the balance that will have to be seen and relooked at. Thanks for that, Sandeep. Rahul, over to you. I think from your perspective, and Rahul, you've been working very closely with your investee companies and largely through the entire life cycle of the company, from an entry to an exit, and you've seen companies transform and create value. So we do have a very interesting conversation later on in the session on how some of the existing portfolio companies are handling the situation. But what is your initial thought on the investment outlook and the significance of due diligence?
So, a lot has been spoken last 15 minutes anyway, so I want to throw a new dimension. So, anyway, from a fund perspective, most funds already are very sharp on their sector focus, are very sharp on the size and the nature of the deal they want to do. I don't think at least I see too much change in that thinking. Of course, this adds a layer, a new dimension of a situation that has happened, and therefore allows you to reset and validate your industry or sub-industry within your industry of how you look at it, because there has been a huge delta on behavior. So let's say financial services, always a hot industry, from fintech to NBFCs. I'll keep the banks away; those are the bigger sizes. But within that, affordable homes, or whether is it a lab product or microfinance, gold loans, we're seeing now the huge delta in how the behavior of either collections or new disbursals or credit assessment is happening given this scenario. And it's a learning. I think that the dimension of learning on the industry or sub-industry or sub-sub-industry is a huge factor to consider in your investment thesis. From a diligence perspective, I mean, I don't think that we should change because I think everybody was being very careful anyways. So yeah, you'll bring in this new. What I'm seeing though is, and some of this is, I saw in your question list as well. I think I'm seeing a lot of importance to ESG for sure. I'm seeing a lot of importance to leadership. And leadership doesn't include performance only. Performance is a hygiene factor now. It's about culture, how you drive culture in the organization. Where are you in the GPTW? Where are you in your value system? Where are you in how you treat your people? All that I'm saying part of GPTW, but where are you in agility? So how nimble are you in terms of as a team to change course if you hit a roadblock? I think those were they always there? They sound very logical, but I think that they will become more important in proportionate terms as we go forward.
Yeah, I agree. And I think our next question is going to lead into some of the things that Rahul, you just spoke about. I think Satish, have we managed to get Prakash back on the panel, or is he still not able to connect?
Not yet, Vishal.
Okay, fair enough. Maybe we'll just move to our next question, and hopefully Prakash should be able to join us fairly soon. In fact, the next question was for leading from what Rahul said, the significance of forensic versus background checks, and not only background checks on the promoters but also on the extended families. Ramki, this is something maybe if you could share your perspective on how would that change. I'm sure this was happening earlier also, but what is going to significantly change in this space going forward?
Sure, Vishal. I think if you look at the whole integrated diligence, I mean, that's a better word, I think. So I guess it's become more popular during the last 10 plus years. And if I have to look back, when the whole country started investing in the infrastructure space in the late 2000s, I think that's when there has been a lot of focus on this integrated diligence. But I guess like over a period of time, it has changed a lot. And initially, the focus I remember used to be to go after checking the political affiliations or payouts. But I guess now it's a lot more broad based.
Yeah.
If you ask me, I don't see the focus changing much during the current situation because that's something which is absolute now. Anything to check about probably it is going to make a lot more difficult for you guys as agencies to conduct these kind of exercises because you got to talk to people at many a time when you get to meet people is when you get a lot more details.
Yeah,
I think the focus will continue to study about what are the family businesses, what are the other businesses, and I guess there will be a lot of focus on related party transaction and consequently diversion of funds. And again, given the current markets, obviously there's a pressure on the top line. So is there any revenue inflation? I mean, I think that's going to be a very, very big focus, revenue inflation. And on the cash flow side, how is the working capital being managed and is there any leakage on that side? So outside this, the other softer areas of focus, I mean, we briefly spoke, Vishal, is about the family members who are involved in the business and how is it going to impact the professionals working in the business. I think that is becoming a lot more important in the current environment.
Yeah.
And then the other thing which you also brought up is the whole use of technology. And in the last few years, I started seeing technology being used a lot in terms of forensic diligence. For example, if I have to give you an example, retail industry, we have used a lot of tools to actually look at the core revenues booked. I mean, you can actually look at the point of sale data and see the frequency of billing, the time to bill, so on and so forth, and see if there are any anomalies. I think there is going to be a lot of focus from the agencies to improve these tools in the current environment, because obviously, physical movement is going to be a lot reduced. That's my way of looking at the whole integrity diligence at this point of time.
Mm-hmm. Sure. Thanks, Ramki. I think that is helpful, and I agree. I think your points around revenue inflation and cash leakages, and I think more importantly around the whole related party transactions. I think that is going to play a significant role in going forward. So I wanted to take Prakash's view also on this point, but I think we'll have to wait for Prakash.
Vishal, Prakash is there. I will just unmute him. He's there in the attendee panel. Just unmute time. Prakash, can you hear us, please?
He's able to hear us.
Hello? Am I audible?
Is that Prakash?
Yeah. Hi, Vishal. Sorry, there is a lot of technical glitches at my end.
Hi, Prakash. Finally, good to have you on the panel.
Okay. Good to have you guys as well. Yeah.
So, Prakash, you are actually coming to the right point. So we were having an initial discussion. I think we were on the first question only, which was more around, how would the significance of forensic DD and the background checks is that expected to increase as compared to what was happening in the past? And if yes, what would be some of the important things that will be required in that space? So, just wanted to take your views as well.
Yeah. So, Vishal, the way we see, forensic checks, I think this is this is for the first time we did it in 2009, right? And we have been investing since 2007. So over the period, this of course has increased. Initially, it used to be, the sponsors, largely. But what we have seen in our experience that this is definitely getting extended beyond the sponsor, which of course would mean their extended family, extended partners, which could be extended relatives and all that. And we, in our experience, have seen that these are some of the important elements. If you are missing sometimes, then probably, had you not done those kind of checks, your call would have been different, right? So in our experience, we have seen that of course this forensic diligence scope is increasing. And in COVID times, when you have to do a lot of things remotely, the essentially, the need for more forensic is going to be there.
Okay. Yeah, thanks for sharing that, Prakash. My next question is more around the existing portfolio companies, and Rahul. Maybe I think I'll request Rahul, Nisha, and then Neha, you from your perspective as well, to understand how are some of your existing portfolio companies, handling the situation, and because obviously for them also continuing to build value is going to be important. So, what are some of the initiatives that you're taking, whether from a technology side, whether from change in operating model? What sort of initiatives are being taken to ensure that the value is intact and grows for your portfolio companies?
You want me to go first? Hello, you want me to go first?
Yeah, please go ahead, Rahul. Yeah.
Yeah, so so this is something working hard last 3 months, and more so even the companies. I think there's been so much learning out of this. Mostly positive. We have about 15 companies that we work on, but I can give you some examples, given that we have a time limit. So I'll give you an example of, we've got a food company, FMCG, B2C, and they make food ingredients like herbs and spices and masalas. And the leadership team, again, it's not a very large company, about 4 crores a month at that time. And, when as early as February 15th, okay, the CEO called me and said that, what if, and the word lockdown wasn't known then, right? So he said, what if, this hits India and at such a scale that we shut down, right? So I already knew that the global BPOs and India-based BPOs were already talking about it because they had to plan 30, 40, 50,000 people. So we had that, this guy started planning his inventory and his distribution network, how it will work if the existing distribution network failed. He also thought through so much in advance that, if there's a shutdown, again, not defined as a lockdown, we had no clue about a lockdown, okay, that, how there will be, restaurants will close down and therefore there will be more home cooking and there will be more home food consumption. And how do we get the ingredients to the shelves, right, of the stores, right? And he actually put a plan, maybe in draft paper. We discussed over a Sunday because it was not important or not critical or thought to be too critical. But, having lockdown happened, of course, first 1 week, everything was frozen because we didn't know what hit us, right? But, first week of April, these guys were, finding their own ways to get to large stores and getting their ingredients on, okay? The team knew that cash flow was tight. They voluntarily said, we'll take a little differ in our compensation. They worked out a little Excel model to say that, we'll take deferred compensation. They put the money instead in raw material, right? So that they could, when the factory starts, they could convert it back into finished goods. And, working overnight while keeping safety in mind, they clocked in June, I'll talk about June, they clocked a 70% increase in revenue over pre-COVID, if I take February as a benchmark. Wow. It's amazing. And the margins, the profitability is all high. In May, they launched 2 new products. They launched pastas and sauces because they figured that the international goods are not coming. So there's an opportunity there. So this is, and then I have another dimension, they couldn't reach out to the stores. They couldn't have all people be on the road, given that, you're taking risk. So of course, it took time to implement the connection to the store in digital form. They made an app where you could, the store could order what they call the GTs. They could place the order online. But in the meantime, they use phone calls, they use Google, they use WhatsApp with Google Forms, MS Excel or whatever. They use that to populate the orders and get the thing going. So I think from a leadership intent, from action on the ground to launching new products to delivering a 70% increase sales, I think something to be really proud of.
Absolutely. Absolutely. And that's a sector that has significantly got impacted, right?
Yeah, absolutely. Despite that, then we have a hospital chain. I won't give the name here, but the biggest thing the hospital lost out was the discretionary spend. All the surgeries that can be pushed out got pushed out. OPD got pushed out because nobody wants to visit the hospital now. But these guys pivoted, and today they've moved almost. It ranges day to day between 45 and 65%. They moved OPD to the home through online consultations, and it's not Zoom. They have their own solution, which is a proprietary solution. So the customer, the patient doesn't feel he's going outside the system. It's a proprietary app, and you can pay through that. You can book an appointment through that. And where there's a physical inspection required, they make sure a day prior a nurse would go there, get the scan done, or get the temperature measured or BP measured. The ones that are possible. You can't take something home. You can't take some lab equipment home, but therefore, I'm saying 65%. If you could take a lot more, we move to 100. But the pivot they've done, and they're now actually saying that we will release half the OPD space in the physical space, pay less rent, and this will become a permanent feature where even the doctor on certain days can be home instead of coming to, and so are the patient, and the patients are, we're all comfortable doing this webinar. So are the patients. Where, I think that these guys and this is completely digital. It's such a solution which is, it's like using an Apple iPad or iPhone, which we say is very convenient. It's not just like a Zoom call. It's a whole customer patient experience right from booking an appointment to your medicines all been tabulated, your frequency, the notes of the doctor, and what to do, what not to do, how to take care, all of that. So it's a whole hog. I think so. This is a permanent pivot in the business model, and this has an impact on your rent you pay. This has an impact on the travel time. This has an impact on the experience and the happiness of the customer. So I mean, I can give lots of examples. We've had
I can see that.
We have a restaurant chain. We have a restaurant chain with 0 revenues, but the leadership team and how they've put together the P&L and the cash flow plan and to how to come together when they start and to hold on, given that there's no money, 0 revenue, and it's beautiful, and you work with them, that is what you call risk, and that's what you call gut and entrepreneurship. Yeah. So it's something to learn. I've learned a lot through this process. It's been enriching.
Excellent, Rahul. And I can see that that passion in you do when you're talking about it, because it makes a lot of difference when you see these companies coming back and just like a underdog, right? So when things are not good, they're finding new solutions.
So we found 60% of the companies have gone pre-COVID plus on revenue and almost 90% on pre-COVID profit plus. So they have, and a lot of it's sustainable. It's not temporary pay cut. There's no much pay cuts, and this is all got to do with the business model and the spend that is being associated with it.
Yeah. So thanks, Rahul, for sharing that. Nimisha, just over to you, and I would love to hear your perspective on your portfolio companies.
So really, largely, it is extending what Rahul just shared as an experience. It's been quite a journey with these companies. When Vishal, one invests in a company, a promoter of business, what one is looking out for is whether they have adaptability to transition when disruption arises or challenges arise. Right? Yeah. And this is what we're looking at in the last 3 months. It was so impressive to see all the portfolio companies react with such maturity and flip their mindset from a growth burn kind of a mindset to adapting to newer models, adapting to cost reductions across the board, as well as deepening. A lot of them used this time, since business was slow or completely down, to deepen their relationships with the B2Bs out there. Just to quickly share a few instances, just 2-3 of quickly. Somebody like AVG Logistics is into logistics and warehousing and has one of the MNCs as a larger client. They stepped up the service levels during these COVID times to such a level that the global MNC's board lauded them for their exemplary contribution in these tough times, right? Yeah. Or another so we have another investment in Fraternity, which is India's largest discovery platform today. And fitness, all gym studios are currently completely on hold. Offline is on hold. They adapted their business model in just 2 weeks to shift to an online model, where across all their consumers, they were able to reach out and give them that fitness experience that one is always looking out for. So the agility with which these promoters act is really, really impressive. And the teams all got together, and it was so much fun working together to ensure that you still there engaged with the consumer out there.
You have Nimisha, sorry to cut you out. You have a very good investment in the sports or sort of entertainment space, right? How have they been able to manage this through the crisis?
So that investment, the company is Smash, and so just like every other company that's under the lockdown phase, and there's more to do with a lot of entertainment, so social distancing comes into picture. The malls are closed. So currently, their business currently is on hold completely. Internally, they have been working towards similar lines, wanting to ensure that cost reductions are in place, that you have these moratoriums in place. You work with your lenders to do a restructuring of sorts. So a lot of again, a lot of thought process going behind what these companies are doing today.
Okay.
Yeah.
Excellent. So you wanted to say anything else, Nimisha?
Yeah. Just to add a couple of more in education space. Like we also felt that companies are using this time well to deepen their partnerships with their customers. So we have a company in education called UPS, which reaches to 4,000 schools pan India. And what they did was, again, within a week, started offering interactive classrooms and e-textbooks to everyone out there. The schools are so non-tech, right, Vishal? Today, they just don't know how to go about the whole online bit. Completely handheld the schools, gave them all these classrooms and textbooks just free straight away, just to ensure that that their education and curriculum goes on. And also in the middle of the lockdown, just to help the schools, create visibility with the parents, launched a coding program which has seen tremendous traction. So again, the promoters are smart, they're agile, they're invested, very, very driven. It was a real good experience in these lockdown times to work with them.
That's really encouraging. Thanks, Nimisha. Thanks for sharing that. Neha, any thoughts from your side? Anything that you've seen with your investee companies?
Rahul and Nimisha, sure. Rahul and Nimisha covered it in detail, and frankly, one thing that I can say is necessity is the mother of invention. And we're seeing that with companies across the board, across sectors. For us, we are sort of investors in funds, and we've got about 250 odd investees in the country. So we've covered. I mean, we have companies ranging from the smallest to very large companies, as well, to listed companies. Also, in terms of sectors, from pretty much every sector that you can think about. So we've seen a whole host of sort of different initiatives that promoters have taken. A lot of them Rahul and Nimisha talked about as well. So I will not sort of repeat most of them. I think people understand that cash is king, and we need to sort of see new ways to reach our customers and make sure that our supply chain is not disrupted. And I think pretty much all the initiatives that are taken are sort of in these three areas, where you're saying, okay, how do I conserve cash? How do I get in more cash? Whether it's by revenues, whether it's by cost cutting, whether it's by giving up your office space, or cutting down on any other overheads that you can, because overheads, frankly, in today's world have reduced to pretty minimal. And then on the other hand, go ahead and say, okay, how do I reach my customers? How do I improve my customer experience? How do I sort of engage with them and make sure that they stick with me, the customer stickiness? And on the supply chain sides, ensure that if there are certain suppliers who are in trouble, how do I help them? How do I make sure that my supply chain isn't disrupted? And I think we are seeing across the board, people are innovating on each of these sort of parameters. So I won't give more examples, but we've seen similar examples in healthcare and in our consumer companies, in our education companies. Absolutely.
Sure. Thanks a lot, Neha. I think that was helpful. Just moving on to our next question, and I know I would want to hear, Sandeep, your views also on the same subject, but I'll link it to our next question also, where one, how are some of the existing portfolio companies handling this, and more from, I think our next question is slightly different, but maybe you can cover that aspect as well, when saying where historical information is not so relevant, and I can see there is a question from one of the participants as well, where historical information may have limited relevance, at least the trailing numbers for last 1 year, and also the forward-looking numbers for the next 1 year may have the reliability may be limited. So what would you do to get a sense on what is a new normal, whether you talk about earnings or working capital?
Sure. And I'll probably, again, as I said, I mean, this context is more, early stage VC investing. So, it may differ from the size and the scale at which you are, and, and the time when you're coming into the organization. Having said that, I think a lot has changed in the last few months, right? In the last 3-4 months, organizations have found a new way to do business. Rapid changes have been made in how businesses are being managed and conducted. So in context of that, historical information may become irrelevant. But I think the first thing that we need to all, go back to is why do you do diligence? Diligences are, at least in our world, are done essentially to establish or validate that you're not taking more risk than you're aware of, right? Because when you go do sign the term sheet, you are aware of what the business is all about, what is it sitting on, what are the sectoral risks, what are the business intrinsic risks, and so on and so forth. So you already have a point of view, right, on the business. You use the diligence to validate all of that.
Yeah.
And the idea of diligence is to make sure that none of what you are not aware of does not come in the diligence report. Having said that, I think few aspects which will become important as we now start doing diligence is, for example, one area, sustainability of the cost reduction initiatives that organizations have taken. Is the margin that you are reporting now, is that going to be repeatable, and is that repeatable at scale? I think that's the first and the foremost thing that businesses would want to understand, because a lot of organizations would show improved margins now at this point of time, better cash flow cycles, and so on and so forth. The idea of diligence now for scale companies would be to validate some of that. I think the other thing would be, for example, we all are hearing that, and I don't know, I hope that's not true, but we all are hearing that there is a second phase of this COVID will relapse will happen and it'll come again in some form and shape. I think all businesses or GPs would want to know about the variability of these costs. How variable are these, and is it possible for you to do up and do down as business cycles go up through this next 6-9 months? I think that's another aspect that you would want to look at. I think in and I probably want to balance this out and not really say that all diligences have to look only forward. I think, having said that, I think there is a relevance of historical information still in diligence that you would do. You would still want to understand how the business was being done in the past. See, COVID is not going to last us for many years, right? Hopefully, it's going to go away in the earliest 6 months. I think if you're more pragmatic or maybe more balanced, you would say 12 months. Outside of that, life would come back to normal, and therefore you would want to still understand the relevance of how the business has been conducted in the past and what form and shape will emerge as business and life comes back to normal. So I would not say that
historical numbers.
Yeah.
It's more an informed, making an informed adjustment to the historical numbers, right? As long as you can do that.
Absolutely.
Yeah.
Absolutely.
Yeah. Rahul, any comments from your side on that piece?
I would say nothing changes. Honestly, I think, as I said before, this gives another dimension of view to the industry and how it's behaved during this COVID time. It also gives you now a very good sense of the leadership quality that's there in the team, how they've dealt with this. So, in my view, will historical numbers be less relevant? In my view, they were relevant on a smaller scale even before. Nothing of that changes. And you have to, in any case, when you made investments at whatever scale, you're always looking at what you can do with the company as opposed to what the past was. The past was relevant from a unit economics or from margins or from the customer side, what's been developed. Obviously, something is cooked. You want to make sure that it's cooked. What is there today and what you can't change is good enough to invest in.
Yeah. Okay. Moving on to the next question on, and this is maybe Prakash, you would want to take this up. How would, just to maintain, I think we briefly touched upon it when I was speaking to Ramki as well. How would an investor maintain a balance between the size of a company or size of investment, whether minority, majority, and the extent of diligence, especially where we're looking at some new diligences, emerging diligences around ESG or technology. So where do you draw a line? How much is enough? Right.
So, Vishal, I will break this into two parts. One is, of course, minority investing, where there are three elements, at least in my mind, which are very critical. is to really understand one, the numbers. So financial diligence is very important. And as a fund, we are seeing not just last 2 3 years number, but we want to see a longer history. So in our mind, at least 7 8 years, 10 years, to really get a hang on those numbers is very important. Probably you can do a diligence of 3 4 years, but we really want to do a longer history, diligence. Second, of course, legal, tax, and all that is important. The other aspects, of diligence today, what is emerging is ESG. Thanks to IFC, and this is what we have learned from them. How important is ISG and ESG? We have been able to implement this in all our portfolio companies, and this is where a lot of companies see value, because when they go out and especially reach out to international customers, and when they are talking, and their business dealings outside of India, a lot of question is around ESG, and we think that this is a very important element. Technology is something, of course, it is on a relative basis, because in the kind of companies we invest in, there are not very technology intensive. But of course, if the business are that kind of technology intensive, you will have to really understand that piece. So
Yeah.
there are special investors who focuses on those kind of businesses, and my sense is that, of course, they are going very deep in terms of understanding. In our mind, technology is largely restricted, that tomorrow, even if there is a chance of obsolescence in that technology, that is not going to impact the business. So which is like, in a regular course, substitutable, replaceable, and they are in usual course of business. They are just more like an enabler than are the driver of the business. So
Sure.
this is how we think. And any amount of diligence is not good. So you, of course, you have to draw that line. And so once you have a comfort on the numbers, and once you think that this is a business model which you really want to back, I think this is where you have to just draw the line and move on.
Sure. Thanks a lot, Prakash. I think that was helpful. And I think on Tech DD, we will talk briefly subsequently.
Yeah.
So moving on to the emerging DDs, I think I'd love to hear more from Sandeep also on the previous question, but in the interest of time, I think I want to cover some really important topics as well. ESG, Neha, this is for you, and I would also love to hear from Ramki as well on the relevance of ESG. And again, we can split this into E&S and governance. This is G, right? So the G sort of segment has always been there, gradually picking up. Governance has been important, but I don't know from an investment point of view, pre-investment point of view, how relevant or significant it was, and how will it change? And more importantly, Neha, on E&S perspective, environmental and social perspective, it'll be good to hear, given that IFC is one of the leading institutes that has its own framework and has been helping a lot of companies implement that framework. So would love to hear that how the significance is increasing from a pre-investment perspective.
As you rightly said, Vishal, governance is all investor. You want to invest in a company which is well governed, because you don't want a situation where the business makes money, you as an investor don't make money. And the critical ingredient there is a well-governed company with a high corporate governance and with high corporate governance. So governance has always been very important. ENS has always, or a lot of times, gotten classified as an expense. Not carry any SD, you will have to sort of spend a little bit of money or train your staff in the necessary ESG systems, etc. So what has changed, and I think we see that quite a lot, not just with our own investee fund, investee companies, but also when we talk to other market participants, that people see ES as no longer just a loss minimization strategy. No, it's just, but also as a profit maximization strategy. If there is a high ENS risk, there is a chance that some of these risks are beyond your control, and therefore there is a higher probability of you losing out on the returns because of some risks that you could not control or you could not mitigate because you did not envisage them or
Yeah.
you did not analyze them.
Yeah.
And therefore, it becomes critical for ENS to be a part of your pre-investment DD, not just pre-investment, but also when you're making your thesis on a particular sector or a particular space, because there are a lot of spaces, a lot of sort of sectors where ENS is very low. There may be one, two companies or a few companies in that space who have a high ENS bar, but is that bar high enough for an investor to sort of invest their money in it? That is something that we encourage our fund managers to look at. So you're right. I think IFC has been at the forefront. We have our own IFC performance standards that are sort of prescribed, and all our investments, whether it is direct investments or fund investments, um, work and follow these IFC performing standards. I think the way we look at it in our own diligence is that there's three parts to ENS or to an ENS DD. First of all, whether you have the right people, whether in-house or externally, and whether you've trained them enough, whether you can hire the right people, whether you have an ENS policy that you can follow, and which serves as a guidance tool to your staff, to your sort of external consultants, etc., when they are doing the ENS diligence. And the third is, what is your reporting mechanism? Whether it is for a fund or whether it is as a fund when you're investing into your portfolio company, whether your portfolio company is also reporting all its sort of ENS risks to you, and is it working on solutions to mitigate these risks? So yes, so ENS in today's world, more so S, is gaining more importance, right? Because in a situation like COVID, it is critical to see how your company has behaved or how the company has behaved in terms of its social responsibilities.
Yeah.
Has it been completely, has it gone sort of out of its way to fire people, to just not take care of any of those benefits that or any of the situations of your employees, or have you taken into account that your employees are also suffering, and have you made taken care of them as well? It
And leading from
sounds
the
like
top as well, right? One at the top is also important. Yeah. Yeah.
correct. So there are companies where the top people have forgone their entire salary, and going from senior to junior, we see that the most seniors have forgone their entire salary, and one level below has forgone, let's say, 30%, and then so on and so forth. While the lowermost rung in the company is actually not been impacted at all, because they understand that at those salaries, sustenance is important, is difficult for them, and therefore they shouldn't sort of do this. And this speaks highly of a company. So when we're looking at new companies as well, I think it is imperative to look at these kind of situations and see how the company behaved, how the management behaved, and how did they sort of take care of these situations from a social perspective.
Sure.
Yeah.
Excellent. Thanks, Amisha. Ramki, any thoughts from your perspective on ESG, and more importantly on the governance side, Ramki, because we touched upon related party transactions, and this is I'm more focusing from a pre-investment perspective, because obviously there will be better processes in place after the investment, but anything that will be more a condition precedent to an investment to say this is a no-no from a governance point of view.
No, I think Vishal, Neha covered most of it. I think what has started as a good to have is now slowly becoming a must have. To be honest, even we started implementing an ESG policy because our investors have asked. And one of my biggest challenges or biggest doubts was, will the portfolio companies accept it? But you would be surprised. I haven't seen resistance from even one company when I spoke about the whole ESG reporting, so on and so forth. I think at a fundamental level, it establishes a framework and brings in some discipline, even from a portfolio standpoint. Imagine end of the year, if you're reporting how many jobs you have created, what's the diversity in terms of men and women. I think that brings in some level of understanding. As a country, the next level for all of us is how does this become a culture in the way we look at things? The second thing you spoke about the whole governance aspect of it. I mean, I guess in the last 5 years, it's become extremely important. Most of the funds do have certain principle. Most of them are unset principle. You will not want to put it on paper, saying that what kind of businesses you want to deal with and you don't want to deal with, etc. And when in doubt, don't even touch such businesses. And the third thing which you spoke about, Vishal, is the economic benefit. I think as a country, we are still at a very early stage. I don't think we have hard data to establish the economic benefit of actually seeing vis-a-vis implementation of ESG. But these are all long-term things. I mean, long-term initiatives show results only in the long term.
Sure.
I mean, it's not just the benefit for the company, but more at an employee level, professionalism, and a societal level. I guess that's what it is. I think the next level that probably will happen is bring in some kind of semblance between the various things which we have. You have your UN SDGs, the Sustainable Developmental Goals. And then you have principles of responsible investment. I hope in the next probably few years we'll see some bit of standardization in all of that. But yes, there's going to be a lot of emphasis on governance now.
Thanks, Ramji. I think that's helpful. And I think just leading on to the next question, and I would request you and Namisha to maybe share your perspective briefly on with the restricted access to KMP, restricted access to the physical assets that you're investing in. Is there any alternative ways of closing a diligence or a deal, or is it only going to lead to, is it like a showstopper to getting a deal closed, a physical access and having an interaction with the team?
Shall I go first, Vishal?
Yeah, Vishal, maybe you start and then, yeah.
So Vishal, see, there are certain aspects of a due diligence that can easily be managed through digitization, and that's what a lot of us are doing otherwise also. So aspects of finance, legal diligence can be done offsite through Dropboxes, virtual access, video calls, are okay to do that initial round of discussion to get all the expected risks that one could think about and take the deal to a particular stage of interest. But the most important part of any deal is gauging the capability of the promoter, right? And that cannot happen without meeting the promoter in person. It's of utmost importance to get that feel, to meet the promoter, do site visits before one wants to really close a deal. So I don't see that going anywhere. I would think that deals may get delayed a bit due to that. But also as things are opening up, and if it's a domestic deal, I think it's pretty manageable also to meet up with the promoters, right? But another aspect, which if there is a deal where there are multiple investors involved, a company may want to do is go the VDD way, right? Do a vendor due diligence. It just in this situation just conveys a couple of things really. Conveys their confidence in their own business, getting a week done in advance and then putting it in front of the investors. And it also saves a lot of time for them, right? Especially when there are multiple investors. So companies are more and more resorting to this kind of an approach, which should work better in this kind of a situation.
Yeah, very good. I think that makes sense, Namisha. I think, and I know someone like I know Prakash from interacting with Prakash in the past few years. Motilal has always been very, very pro vendor DD because of the reasons that you just shared. So Ramki, from your perspective, does that also is that the solution to the whole restricted access issue and also with the elongated duration of a DD exercise because of new DD areas coming in, trying to get more comfort over the promoters, their relatives, related party transactions, plus getting comfort on ESG or governance side. Do you think VDD is the way to go going forward?
So I think VDD, Vishal, is probably one step forward in the whole diligence process. I think we have to remember very clearly that VDD as an exercise has been initiated and managed by the seller. So to that extent, the buyer will always read this report with a lot of caution, right? However, it helps the buyer on two accounts. As Namisha said, one in terms of the deal closure timelines, you're better prepared and things like that. And then most importantly, it will help you run a non-exclusive process. I mean, I think that's the most important from a seller perspective. And I guess let's say that there is an issue that is flagged in a VDD, because it's a process you have started, you can really try and fix it before the final report is published. What you got to be very clearly remembering is that when you actually sit in front of the potential buyer, there is a good chance that he will do a top-up diligence, or he will actually, like, in the worst case, want to do a complete diligence. But at least a top-up diligence will become thing. It will really help you important. But I guess what is important from a service provider like you, Vishal, is the balancing act. It's a bit of a balancing act, right? One, you can't but report the key issues. At the same time, you got to satisfy the person who's paying you the bill, right?
Yes. Yeah.
How do you actually balance these two aspects? Because finally, it's a credibility. I don't want to actually, like, look at a VDD report in my investment and 3 years later, 4 years later, realize that, listen, when this was goofed up, and then what kind of image I carry about the service provider.
Absolutely.
So I think it's an extremely important thing for the service provider. How does he balance both?
That's a very good point. I think I've taken a note of that. I think, Ramki, it's a very relevant point. I know there's a lot of interesting discussion going on, and we are slightly behind schedule. I want to spend maybe a couple of minutes between Sandeep, Nimisha, and Rahul on quickly what are the top 2 or 3 issues in the balance sheet that you would look at for a target company, especially companies or businesses that have got impacted by the COVID-19 event. So Sandeep, maybe you want to start, and then a couple of thoughts from Nimisha and Rahul as well.
Sure. I think, and as everybody knows, and this has been said quite often, and probably will be repeated, for a few more months, cash will be, will be a reality for some time, I think. So there will be extreme focus on that. And therefore, what I mean is things like what you're carrying on your balance sheet, how do you see the recoverability of that? How do you see the recoverability of your revenue? Because this will all impact your runway, at least for young companies which don't raise cash for outside of 2 years. That assessment then becomes very critical. I mean, like, for example, if you're carrying inventory, given there has been lockdown, could there be inventory obsolescence which you need to account on your books, or do you expect more returns to come from your retail partners, channel partners, because they've not been able to sell? And all of that can impact the balance sheet position. That's one area I think clearly that I see more importance being laid on, or more time being spent. I think the other is people who have opted for relief, from banks. What have been the renegotiation of terms, the rescheduling, the moratorium? What have been the additional covenants that they have put in, and what kind of impact would they have on the business? I think that's one key area that will probably come out. And third, from my standpoint, I would like to maybe critically analyze related party transactions, and just want to make sure that there's no deep potentially conflict of interest, especially during this time. And is there any assessment of impairment or provisioning required, given the time that we are in? I'll probably make it quick, and I know you're running out of time, but at least keep it to these 3 things outside of cash, as I said, working capital, which will be the key focus.
Okay, thanks, Sandeep. That is helpful. Rahul, quickly from your perspective, in addition to what Sandeep said, impairment of assets, working capital, cash, inventory.
I see huge opportunities. So I won't repeat what Sandeep said, but I see huge opportunities in companies' balance sheets. They got advanced tax. They got I know it's retail store, nothing to do with our portfolio companies, but I was looking at it one Sunday, and they have 16,000 SKUs, only 4,000 sell. So I think that there is a lot in the inventory stock than receivables. Because if you're an infra company or even in services, okay, if you've given you've done work and given credit to people who are not generating income, you're going to get stuck. So I think there's a huge opportunity both from a structural perspective and from opportunistic to look at the working capital side and some other assets like deposits and tax advances, which you can either release quickly, get the money out, or change and improve how you do business.
Maybe I'll add to what Rahul said. I mean, in fact, across our portfolio company, which is like 140 portfolio companies, we ran this specific program to see how you could, get your taxes refunded by the government quickly. And we worked with somebody centrally to help companies get money out. I mean, that was one way of liquidating the assets stuck in the balance sheet, especially when liquidity was at a premium.
Yeah, that's interesting. So we'll capture that, and I think just for the sake of, and Nimish, I'll come back to you quickly. Just for the sake of everyone and the participants, I think we will be capturing the discussion. There will be a recorded version of the discussion we're going to have today, which will be shared with everyone, and also we will be circulating a brief summary of the discussion through a point of view document. So there are some really good points that are being covered here, and I won't want to miss any of the points. My only small request is whoever can stay back. I think I'm consistently looking at my watch, and I know we're going to go 15 minutes, at least 15 minutes above the scheduled time. So with the opportunity to have such a good panel here, if you can stay back, please stay back. And because I also want to answer some of the questions. There are already some 12, 13 questions that are there. So please bear with us. I think we'll overshoot by 15 minutes, 15, 20 minutes. Nimisha,
Vishal, we're going to overshoot. I just need to let the next meeting know that. Give me a minute. Carry on.
Nimisha, quickly on the balance sheet side, any other key items that you think will have to be kept in mind? You are on mute, Nimisha.
Yeah, it's going on auto mute.
Oh, is it?
Yeah, it is.
Better? Yeah.
Yeah.
Okay. So one thing that I feel that has come out as a positive out of COVID is every company's awareness and seriousness towards managing working capital to ensure that cash is released. Companies are always funded, and balance sheet management and working capital management remains somewhere at the back of their mind. Now that there's a situation where they need to stretch their runways maybe up to the next 15 to 18 months at least, till things shape up out there, working capital awareness has really increased across all companies. They're more cognizant about inventory management, the quality of the receivables, the relationship with vendors, careful where contracts are being also signed off unless there is extended load clarity or OEMs are kind of giving them confirmations, right? So survival is the key, is what all the companies are taking away from this. And at the cost of sounding very cliche, let's say that cash is definitely king. I mean, it's the golden rule of investment that every business has to be cognizant of this, that investor interest will come not only by your capacity to do revenues and businesses, but also the ability to stretch that invested dollar. So I really feel that just for the first time, COVID has brought that kind of awareness across the board amongst companies.
Excellent. Thanks, Nimisha. We'll just move to the next section of the discussion, which is more around deal structure and potential valuation considerations. So, and this is, I would probably put it to Ramki and Neha. Ramki, what are the key changes or new clauses or conditions precedent that you think are expected to be included in the term sheets or SPAs post-COVID, if there are any new that you think? Sorry,
he's on mute.
Yeah, there you go. You can hear me now? Yeah.
Yes.
Vishal, I was saying, just one step back. If you got to look at deals in the current perspective, I will probably categorize them into two parts. One, deals where you're already beyond the term sheet and in the process of diligence, and second are new deals.
Yeah.
So for where deals you are already in the midst of diligence, you can most probably, in many of the cases, you should expect some negotiation of valuations, and maybe you will start seeing more emphasis on downside protection.
Yeah.
And timelines will be extended, so on and so forth. And if you are looking from a new deals perspective, which also accounts for the old deals, what is most important, as we had already discussed, is to look at the impact, whether the impact is going to be temporary or permanent.
Yeah.
And that's something which we have been focusing. And if even if there is a bit of doubt that it's going to be a long-term permanent impact, we will not continue the discussions at all. And whenever we see there is a temporary impact, the whole idea is to look at what are those drivers and how do you actually introduce these drivers into your agreement, saying that like if you want more reps and warranties, let's say that you have a contract with an MNC for 5 years with a minimum guarantee. I mean,
Yeah.
let's imagine that the MNC says that, yes, the contract is there, but I'm not going to lift whatever I had promised. What are you going to do about it? Right? You just can't do anything. I mean, because the balance is probably not in your favor. So I guess these are the kinds of things which one may probably want to bring into your reps and warranties into the agreement.
Yeah, and thanks a lot, Ramki. Neha, do you think there will be some condition precedent in the form of deferred or contingent consideration, just taking up from where Ramki left, and also from an ESG point of view, do you think that is going to be a condition precedent to lay down a roadmap of ESG implementation plan, given considering a lot of companies would not have a proper plan, right? So would that be a condition precedent, you think?
I think to your first point on the commercial side, I focus on performance milestones, and therefore clawback for the promoters or the management to get more of the company if sort of their performance is not up to the mark, or if the performance is up to the mark, then they can get a lot more.
Mm-hmm.
On I think apart from that, on the commercial side, as Ramki mentioned, there are a lot of other things that you could probably put into the reps and warranties. But from a CP perspective, I don't think it could be very different from what we've already seen. On the ESG side, I think ESG is already an integral part for certain investors. I don't think investors who've not focused on it or who are not focusing on it for will try to do more at this point in time. There will be a focus, but I don't think it'll become part of CP. So, as part of diligence, I think there'll be more focus. As part of your pre-investment evaluation, there'll be more focus. But I doubt if there will be too many more CPs relating to that, which would come.
Okay, that sounds to be good news for companies who are looking for capital, right? Thanks, Neha.
Investors like IFC, just to add, but investors like IFC who already have ESG in their CPs or in their
They would expect that.
will continue.
Yeah, I agree. Okay, so this is for Prakash and Rahul. What sort of new deal structures do you think would come out? If there are any new deal structures, whether it is in the form of, consideration not being completely equity driven, or whether it is any other, conversion options, call put options, will they have a same significance or not? So what do you think from a structuring point of view? Will that change? Any new structures that you are experiencing? Maybe Prakash, maybe you can start and then Rahul can add.
Sure, Vishal. So, what we have seen is all usual structures, which is convertible.
Yep.
At this point in time, I think some of those structures would be more prevalent because the visibility in the business, depending on the visibility in the business, right?
Mm-hmm.
uh, I think that in these kind of uncertain times, you really don't know how long this is going to last. Whether this will end up in 6 months or it will take another 1 year, or it will flow into FY22. So of
Yeah.
course that is one part of it. But what we have seen is that fundamentally if you are able to take a call on the business, right, and if you are able to cut a deal which is straight, then of course uh, structure is something as an investor we would like to stay away with, and be with the company and the management as they are. But yes, these things becomes important when you are in a situation where there are multiple guys looking at a particular asset, and then you have to work around, right? So convertible is one element which I think is
Prakash,
something which
sorry,
will
do you?
probably become more prevalent, in the
Yeah,
next 6 to 12 months time. But in our portfolio, we have tried to avoid it as
Prakash, just on that point, do you think step-up acquisitions will be a new thing, where companies, investors are going to be slightly more cautious of how much do they invest in the first stage, and then gradually, it might be a step up over the in a phased manner. Prakash, you there? Sorry, Rahul. Maybe you can pick that up. I don't know if Prakash is able to hear that.
See, historically, deal structures happen to solve for a value gap or an existing, sometimes when a simple equity structure does not reflect the value, how the value would be created and the risk taken by each person over a period of time. So ideally it should, because you're putting in capital, but there's sometimes effort, there's sometimes a gap on the entry valuation, or sometimes there's a gap on other points of business that allows uh, a complexity or a derivative to come inside. So will this cause that? I think in some manner, yes, because it all of this just puts down a little more grayness in how this will shape up. So will it increase? I think that, yeah, you'll find new ideas coming out for sure, because every time we do a deal, I find more intelligence and more revised derivatives coming out of it. So it's a good thing if it solves a problem, and it's a good thing if it allows in a fair way to, at the end of the day, after 3 or 5 years, when you want to exit, it correctly reflects the value created by each person, and if the person's getting compensated for that, I think it's a good thing. I think unfortunately there are a lot of regulatory hurdles in India, so we got to live within those rules. But yeah, I think that some of this will give new ideas coming out for sure.
Excellent. Thanks, Rahul. We'll just go to the last question before we take the Q&A, and that's maybe Sandeep and Nimisha, for both of you. Any thoughts on the changes in the valuation basis? Obviously, it'll remain. Do you think it'll remain a gray area? Will there be some new valuation models that will come into play, considering the trailing numbers or the even 1 year forward numbers may not be as reliable as you would want them to be? Sandeep, maybe you can start.
See, as COVID-19 has permeated every aspect of our lives, it is, to me at least, not a surprise that some bit of economic impact of this is coming on business valuations too. The stock markets have corrected, so the private markets also have to correct. But I think, I would like to caveat that by saying a lot depends on the fundamentals of the business and the sector that you're part of. For instance, if you look at the communication space today, and if you look at, I don't have too many public market companies in India which are in this category. But if you look at the US market, today they're quoting at 25x of revenue. If that's a surrogate that you want to take, and and we are investors in one such company, and we've been getting requests from bankers to start conversations, not at that multiple, because obviously those are very at a different scale, but definitely what we were hearing 9 months back has moved up. So clearly, I think it'll be a function of where you are. Anything which today is digitally enabled and allows you to ramp up very quickly, reach out to your customers, will have a premium. Anything which is more offline, and which is heavily dependent on brick and mortar, will probably not move as quickly or as what they were doing earlier. I think it's a lot dependent on where you are and how the fundamentals of the business are. But having said that, I think good businesses will continue to command valuation. And I just want to say that irrespective of the segment or sector that you're in.
Dimisha, your thoughts, considering it's very difficult to assess the outlook of the businesses and the outlook of the forecasted numbers. What would you think in terms of the valuation discounts, especially discounts rather than premium? I know premium is easy to identify considering the technology play in the business. It's more difficult to have a conversation on the discounts, right? Especially for some of the businesses that have got impacted.
Vishal, my view is that valuations will definitely see a risk premium associated to it. Thankfully, COVID came around the end of FY20, so there is definitely a past number to benchmark something on. But because there's no clarity of growth patterns or revenue streams for certain businesses, those businesses will definitely have to have a risk premium associated to it. Nothing can take away the assessment of companies based on their past performance, of course, because that's what the founders have shown that they can deliver, right, with this business model. At the same time, for future valuations, I would feel that from across sectors or many more sectors, it will remain more floating and more of a multiple of certain future performance indicators or KPIs that one would want to put on the table rather than giving fixed valuations. So just to give you an example, would I give the same multiple to a good hygiene and sanitization company that I would have done if COVID would not have been there, when everyone is entering the space and is totally cluttered today, right? I wouldn't do that. I would definitely discount that kind of company in terms of its valuation. So it really all depends on which sector one is looking at. But eventually, it'll all matter to the foundation of that particular company, because as we move along, I expect almost 25 to 30% of startups will kind of fall through, and only those who were smart in utilizing the capital will prevail. And hence, they will capture that vacated market space. So it's literally the survival of the fittest over here, for sure.
Yeah. Thanks, Nimisha. So I think it was it's been very, very good to hear from all of you, and I would love to continue getting some thoughts. But we just get to a Q&A session. I know we've gone overboard on the time. So we've got a few questions coming around. Let me just pick one by one. There is a question around, if there is, given how 3-year historic period may not be an ideal proxy to say the next 3 or 5 years, what particularly would you as investors have your financial DD team look at? So maybe I can put it out to Ramki. If the last 3 to 5 years information is not as it used to be, what would be a financial due diligence team look at to give comfort to the investors?
I think, Vishal, this probably has been covered in a different form. The way I would look at as just look at as a split year, just look at a breakout year, and then say that when the business comes back, how would actually the margins and the trends kind of come back to the old trend line. I think that's the way I would look at. You just have to look at FY21 as probably a normal year, and then look at the other trend lines as you would normally do.
Yeah, just going back to your previous point on whether it's a permanent or a temporary disruption. If it's a temporary, then it is a split of a year, right?
That's right.
In terms of technology play, and this is not about tech-enabled businesses, and maybe Sandeep, you can answer this. If it's not a tech-enabled business, what would be the role of a technology DD, especially where a lot of operations are now being tech-enabled? So it's not an ed tech business or a health tech business or a consumer tech business, but because companies would be implementing sort of work from home thing opportunities, there would be issues around IT security, data security. So even more brick and mortar businesses will be implementing some technology led initiatives, right? So do you think that will also play a big role in the VDD or a DD to make sure the business is sustainable? Sandeep, you're on mute.
Okay. I'm sorry. I was on mute. I was saying I'd probably answer this a little differently. And let's assume it's not a tech business, but it is enabled through technology. And what I mean is, for example, I mean, I think somebody from the panel was giving example of a food company, which has started delivery online, and they have clocked stupendous growth in the last 3-4 months. There, I think the role of technology becomes important, and the diligence around that becomes important. And for lack of a better word, I would say that in that kind of a company, I would want to do a little bit of diligence to see how the large scale adoption of technology has led to that growth. Do a little bit of check on customer profiles to see that are the orders coming from same set of people, or are they coming from unique set of customers? Sometimes, and this is that we've learned that you get to create demand on an online business it's not as difficult as you would have want to do it on an offline business as well. So you kind of generate demands artificially and want to weed out that aspect of revenue and make sure that you're not underwriting something which is not really true to reflection of business. So I see use of technology or the use of diligence to vet something which is digitally enabled. I would also use social media and sentiment analysis. There's some bit of crawler analysis that today we've started using for looking at what feedback are you generating, because everything is consumed digitally. Therefore, what feedback are you getting from your customers online? Are people happy with what you're giving them as a product? Are there too many complaints? So generally, what's the vibe that's coming?
Yes, social media has also got a role to play, right?
Exactly, and that's what I meant. That social media sentiment analysis, look at all of that and pick that up, and feed that into your investors and form a view through on diligence on that. I mean, at least typically at our early stage, I mean, we don't lay too much stress on IT general controls, but what we lay stress on is the fact that you have to have good quality auditors. And those, as part of our mandate to them, then they get covered. These things get covered through that process. We necessarily don't, ourselves go and spend time, but we spend time on all the other things that I spoke to you about.
Yeah. So Rahul, from again leading from the same point, again there are questions, a couple of more questions around technology, DD, more focusing on the increased significance of data security, IT security, especially with a lot of people now working from home, and that might become a new normal going forward. Would that also have an impact on getting comfort on that there is adequate security around the data that is being shared with either the customers or even from a vendor's perspective, right? A lot of work may be now required to be done online through virtual data rooms. I know the due diligence used to happen virtually earlier also, but there could be a lot more operational data that might be exchanged through virtual due diligences. So will that mean an increased scope from a technology DD perspective, Rahul? You're on mute.
Yeah, it goes on auto mute, so we get a bit lost about that. No problem. So no, I think there are two parts to your question, if I am not mistaken. One is the getting a diligence done. I think that 2-3 years ago itself, we had moved to a very robust process that we set up for all DDs, doing them virtually. Of course, if it's a factory, you will want to visit it in person. I think that you still can't take away because you must know what you're getting into. But a good 90-95% is very organized way of getting a DD done. Of course, it doesn't work when you have a bidding process and there's a VDD run already and stuff. But otherwise, yeah, from a secure way of doing DD, we've got these we've engaged these companies that run. In fact, it came to a process where when we do exits, and I run this process quite strongly, is that the person that the data we upload, we decide who can see it, whether it can be printed at all or even be downloaded as Excel file. Because there are product data, there's pricing data, there's costing data, or there's customer lists we do not want. You can have a look. Maybe you can take a picture with your phone, right? But you can't download it or even print it. And there is noise around it, but we say we give you the access. What more do you want? So there is a lot of work being done on this. I think these are very important things, because at the end of the day, in the competitive space, there's only 2 or 3 winners, right? So this is critical. This is critical. On the operation side, I think I know that MNCs and large corporations were already very strong on the information security side in the way data is handled. Okay, I think Indian companies were in the range. There is no number to it, but they were relatively lax about it. So I think that we're seeing last 2 years even before COVID, some of them naturally, when they had a good IT team, they would say this is important. We need to secure the data in a better way. In the more recently, we had one of our companies where the server was compromised, and everybody's working from home. The server's in office, and the server got compromised because somebody hacked into it. It's very obvious. You got to get all these things sorted out. Invest in strong security systems.
Yeah. Okay. Thanks a lot, Rahul. I think that sums it up well. Look, I am really sorry that we've extended beyond our scheduled time. I would like to thank each one of you on the panel, also the participants, for showing the patience. I think we've had an excellent sort of set of session and some very good interaction and takeaways. So we will sum it up and have a recorded version of this discussion also shared, and then also come up with a point of view document that will be circulated to all our participants and clients. So thanks a lot to all of you, Ramki, Neha, Rahul, Nimisha, Sandeep, and Prakash.
Pleasure.
I think it's lovely having you.
Thank you.
Thank you.
Thanks, guys. Have a good weekend.
Thanks.
Bye.
Yeah.
Thanks
You
so
too.
much.
Stay safe. Bye.